Hey everyone, it's Jay Soloff from Investors Alley and Options Floor Trader, and this is our Options Trade of the Week. So I'm back here at Market Chameleon looking at the Options Block Trade Screener, where we can look at big trades that happened today. This particular day is July 12th, so we can see what kind of action there was in the market. So if you want to narrow it down and maybe you're looking for a certain type of trade, you can go to this trade condition and you can look for things like buy rights or intermarket sweeps or combos. So I'm going to go to straddle, and you'll see what they mean by straddle here is they use it for both. The term straddle condition is both straddles and strangles, which just means you're buying or selling both a call and a put in the same expiration for the same underlying, like this one with looks like Citigroup here, where there's a trade of a call at 80 and a put at 64, so these would be both buy or both sell. If it's at the same strike, like in this case the 28 with XLF, that would be a straddle. If it's at different strikes, it's a strangle. It's all labeled as a straddle in terms of the exchange labeling of the trade. So all right, so let's look around. What do we see here? Anything interesting? Maybe sort by quantity. Here's some. Now these cost a lot generally, so you're not going to see necessarily huge quantity. 800 is quite a bit for a straddle. Let's look at something like GDX. That's gold miners, right? And gold's been in the news a lot recently. So if you look at, and this is a January trade, so this is a longer term trade, at least for in terms of options. And it looks like someone is spending quite a bit of money. So let's take a closer look at this. We'll go to GDX. This is the VanEck Vectors Gold Miners ETF. You can see that gold has been on a run recently, possibly due to the idea of lower interest rates, possibly due to just the threat of the dollar going down. You can see it's jumped up quite a bit, and gold miners tend to track the price of gold. It's definitely gone up quite a bit lately. So let's take a look at that. Let's take a look at that trade. Something like that will usually show up if we go to the option chain and we go up to key trades here. We can usually find it. They usually you'll find straddles and stuff in here. So here it is. Here's a bunch of them. Looks like we had several trade all about the same time. So this was a lot. A lot of these January 17, 20 straddle, actually might have been, after all is said and done, it looks like there's at least 1,000 of these that traded. So let's just pick one of them. Let's see here. Let's just pick one of these straddles. This one was 206. So you could see, though, that this was a big trade. It probably, again, it looks like at least traded 1,000 times. And that's quite a bit for a straddle. And so you could see the payout here. If someone is purchasing, and first of all, let's look at the market was 410, 412, and they paid 413. So very likely purchasing a straddle and not selling it. The stock price was at 26.20. So stock price is at 26.20, and they spent about $4 on this. That means by January expiration, January of 2020, we need to go above 30 or below, roughly 22 for this trade to make money. That's quite a bit. I mean, we're talking about, 15%. Yeah, that's about a 15%, 15 to 20% move in either direction. That's quite a bit. However, that's also about 6 months away. So someone is betting on gold prices and thus gold miners to make a big move in one way or the other. And they did this about 1,000 times, so they spent a fair amount of money. 200 of these cost 85,000. So just multiply that by 5, and you're talking about 425,000 spent, and that's what is your max risk on something like that. If it ends at 26.20, or actually 26, this is 26 straddle. If you end at 26, you would lose all 400 some thousand. Obviously, break even is either of these points. These are somewhere in between, and then you can make an unlimited amount essentially in either direction, although on the downside obviously you're limited by 0, and obviously all gold miners aren't going to 0, but if this goes on the upside, there could be some significant upside potential. But this person is obviously not necessarily settled that gold is going to go one direction or another. They just feel that it's going to move quite a bit. So interesting trade, something that you could do yourself in your own account. It's just buying. You don't need any major permissions. Just your standard option account should be able to do the trick. And if you want to do something cheaper, you wouldn't have to go all the way out to January. So let's say you go to October, and instead of spending $4, let's see, the 26 straddle costs closer to 3. So you could save some money if you wanted to go a little bit closer. Or you could do a strangle where maybe you're doing a 25.50, 26.50, and then maybe it would cost $2.25. So there's different ways you could save money on this. Obviously, the longer you go, and if you make it a straddle, it's higher probability than if you go closer and you make it a strangle. So just some things to think about if you want to do a trade like this on your own, in your own account. If you are interested in learning more about these types of trades, straddles, strangles, you want to check out my option trading mastery courses. It's a package of courses. There's 11 of them. It's about 6 hours worth of video courses where I teach all different aspects of options, including things like straddles and strangles. So check out the link on this page if you're interested in taking a look at my course. Thanks a lot.